Good morning. My name is Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm John Darcy, Editor-in-Chief, and together we bring you the Morning Call. So Scott, yesterday we recovered from another small gap down to continue this stair step or escalator or whatever you want to call it higher. It's just been a slow grind higher. There's not a lot of excitement intraday for traders, but swing traders are loving this type of action. What are you looking at right now in the market?
I think today we have the FOMC announcement coming out, so that could shake things up a little bit. Sometimes what you do have is you have a trend that then gets accentuated into the Fed day, and then either last hour it reverses or the following day it reverses. But I can't, say you have to put all your emphasis on that. What we do have to emphasize is that there's been a great sector rotation. There's been a lot of money flowing, a lot of great setups, and the S&P has been following the 8-day moving average for all of 2013, not even giving a gut check. So with that said, John, a lot of people are trying to, discount it, or handicap whether it's going to happen. And so far, if you try to, press a short when we have a little bit of a pull-in or add to hedges, goes against your long. So there's just like a bit of frustration amongst every player, I think, right around here.
Yeah, as we were talking about earlier, Scott, is that everyone's frustrated. Even the bulls are frustrated because they're looking for a pullback to get more heavily involved because they've been trimming and trailing positions, as Scott talks about. And then the bears have been frustrated because anytime they've tried to add to shorts on weakness, they've gotten squeezed out of them. So bulls are not as heavily involved as they like to be, and shorts are just getting frustrated at every turn. What's the type of thing, Scott, that you would look at as an inflection point to perhaps add to hedges with confidence and look for a little bit more downside in the S&P?
I think we have to look for some type of composure change. So there's like two ways that could happen, two ways for me to switch some gears. We talk about, portfolio approach versus tactical approach, having, 5 to 15 positions on with a tier system versus a hedge, and, how to manage it. So if you look at the chart of the spiders right now, you will see, here's the beginning of the year. This was your big gap up. Everyone was all worried about the lack of volume and the lack of activity, but what it was nice digestion before we continued higher. So what we've been doing is following this 8-day moving average. So what I would say is two ways to see if we get a complexion change. One, which could happen today, here's your pivot resistance. Pivot resistance is yesterday's high. Yesterday's high is 150.85 in the spiders. Do we press through it, squeeze shorts that have been rolling it up where they finally get squeezed, where those bulls you said were waiting for a pullback finally buy, and then we go higher and close below it? That would give you some type of topping tail, kind of the reverse of right here. Remember this move to the downside, and then finally we broke below that low and reversed higher, and that changed the trend. So something like that. Or you see this methodical uptrend that's been following this 8-day moving average. I would say it closed below 149.68. You then could see a move back to retest to 148.11 of the 21-day moving average. But so far, that hasn't happened. And anyone intraday trying to handicap that or maneuver that has been frustrated. And I'll tell you, I've given back some money every time we've pulled in. Instead of just covering my hedge, I've added to it and not massaging the longs enough at this stage of the rally. So at this stage of the rally, take a little bit of a step back approach and just realize also that we have a long year ahead of us. This is January. You have 11 more months. Don't get frustrated. If you didn't outperform the market in January, big deal. You'll have another chance.
And last night, if you guys didn't see it, on CNBC's Mad Money with Jim Cramer, Cramer shared Scott's analysis on the S&P. Last February, Cramer also shared Scott's analysis of his roadmap to 1,700 in the S&P by 2015. And one of his first things was that we need to test this all-time double top in the S&P as the first step towards getting there. And at these levels, yeah, we might need a little bit of rest. Scott, maybe you want to expand on that a little bit.
Well, last year in February, when there wasn't a lot of bulls, I said we have the roadmap to 1,700 by 2015. And I got some hate mail, people like, you're a market cheerleader, blah, blah, blah. Meanwhile, technically it looks set up. So he did a great job, Jim, going over the different time frames of the market. And I talk about obstacles. First obstacle this year was getting above 1474. We got above it. That's what took us to 1,500. You go back to the chart here, you'll see, this was that pivot. So if you were short versus that pivot, you had a cover. And then we continued. Let's take this little mark that it did out of the way. So now you go back to really the weekly chart. And if you take a look here at the weekly chart, you will see this long range this market's been involved in, or let's go actually, there it is, okay, where you'll see where we're approaching this double top that was put in place, in the course of the last decade. So within the last decade, you had a double top. It was really the decade of the market timer. You know, we've talked about this many times. Remember here, you had an uptrend that we talked about the roaring 80s, the go-go 90s. This is when it broke. This is when you risk off. Here's your descending channel. Here's when we broke above it. Here's your risk on. Okay, and then you had another, you know, ascending channel or another trend that we broke below, retested, and then failed. So that was risk off. And then from here, you know, you had that big low. You know, you had your outside day. Remember, you know, this was, you know, after the financial crisis. And then since then, we've been slowly and methodically going higher with a low or higher low, another higher low, another higher low. And we're coming up to that double peak. Now, first time we get to this, you know, it could pose some resistance. You have like 1540 to 1565, but I think ultimately we take that out and we get to 1700. And if you go back again to the monthly chart, you know, he showed this. You know, this wasn't so outlandish. Look at the move that the market had from, you know, 1990, you know, the 80s, actually 1976, all the way up to the highs. So here we are again. You know, you don't want to cheerlead this high, you know, and just initiate here. But those who've had a macro plan are getting rewarded, and those that think we can't go higher, you know, you don't remember the times when we did. And at this particular point, we take out 1540 to 1565. We're going to see a continued move. The question is, can we do it on the first try, or do we have a pullback? So that's when, you know, we'll say whether risk on, risk off, tactical versus portfolio. But that's why, again, there's 11 months left of this year, so I wouldn't be so upset if you missed the first month.
Well, let's go ahead and transition into earnings and tech specifically. Amazon was the latest tech stock to report last night. The company, when they came out with their report, they missed on EPS, they missed on some other metrics. The stock initially ticked lower, but then people started to look into their report a little bit, and it's more of a margin story. And Amazon started taking higher and is near pivot highs this morning. Scott, what do you expect from Amazon today?
I think you expect the unexpected, and people who've tried to short it after hours, they're getting torched. People who've been trying to short this based on the PE that don't understand the story, they're not having fun. Those that believed in the story, congratulations, because I haven't believed in the story. I haven't been focusing on a holding, but technically it's been the chosen one where it's actually near highs, above all the moving averages, been acting well. It's been acting well year over year. So if you are involved in Amazon, congratulations. Just if something does change, you got to sell some. We saw things change in various stocks, the last one being Apple, you know, where it can pull in. But for today, as a trade, I'm going to watch the previous pivot high. If you go to the chart right here, I am not in Amazon. It's flirting right here. If you were another short in this thing and it took out 284.72, you probably would have to cover. So if you are short, use that as your pivot and just lick your wounds. But if it happens to trade above it, okay, squeezes through, runs out of gas, comes back below, that could be, you know, your pivot top. And then that's what you could short against. But I would be very, very careful and keep your size down. So if you want to be long Amazon, I'll tell you the truth, I wouldn't be chasing it here. If you want to be shorted, I would wait for, you know, a pivot high, so to speak, to trade against, because who knows where it goes. You saw what happened to the people on Netflix who tried to do that. They got crushed. So all in all, this is your pivot. 284 is your pivot, and then trade around it based on your skill set and your time frame.
All right, let's continue in tech with Apple. Apple's been a lot less impressive than Amazon. The stock's been a rock since it topped out over 700. The earnings report was disappointing. The stock has continued to be heavy. But the last 2 days, we've seen a little bit of perking action from Apple, and it's starting to show a little bit of signs of life. Nothing terribly exciting, but Scott, do you think this could be a short-term bottom for Apple, or do you expect it to get back to its lows?
Let's just let it build. You know, I know 2 days ago when it was in that gap below 440, I was looking for some type of reversal. It wound up going positive. It was a nice trade. It closed near the high. So I'm like, you know what, I'll stick with this. You know, lately during the debacle from 703, you've had time frames where it's actually acted well for 3 days. Only once or twice did it act better than that. So, you know, what I'm going to do is I'm still in it, and I'm going to judge it. And if it continues to hold up and show some commitment, I'll stay with it. If you look at the chart here, you'll see there hasn't been much commitment in this stock since it topped out at 700. Here's when, you know, it broke the 21-day moving average. Here's when it broke support. You know, it tried to bounce off the 50-day. What happened? 3 days down. Here it tried to bounce. What happened? 3 days down. Look at this, 3 days down. And then finally, after being stretched to the downside enough, you had a red dog reversal. It gapped up, showing some commitment. Okay, then it held the top third of the range before being controlled by this downtrend. Okay, then the last trade, this was a tradable move too, where it gave you 1 day, some follow through, and then it failed. So let's, lo and behold, here we are now. So I'm not going to jump the gun and say this time is different. We'll let it prove to see if it's different. So far, nice little trade, little bit of follow through. I would say for this to be any good, it's going to have to hold above 452. Let it hold above, go sideways, and then perhaps we get a trade back to negate some of the pressure of this earnings gap, and then here is your 483. But if this stock starts to take out 452, I'll be out of it in both my accounts, and then I'll just figure out, how long it needs to be in this lower range before maybe breaking below or making another attempt. So 452, I would say, is support. 460 is micro resistance, and then real resistance is right here around 465.73 for that earnings gap.
And the third big name in tech that we focus on a lot, that's also, along with Amazon, become a leader in the sector in the absence of leadership from Apple, is Google. Last quarter, the company had their earnings leaked intraday and had that big harsh sell-off, but the recovery from that sell-off has been very impressive. And this quarter, they delivered good earnings, gapped up, and have held. Do you expect Google to continue to provide leadership for the market and continue higher?
I think as long as the market doesn't fall apart or have that pull in, I think that it's one of the chosen ones. You had the gap up after earnings, and then you saw commitment to that gap up. So if you look here at the chart, you'll see here's your gap up, which we talk about in our swing trading course. If you gap up and it doesn't fill that gap, that means there's pent-up momentum. You had a 3-day move, and now it's flagging right in front of these prior highs, which is 774. If we take a closer look, you will see that there could be another entry here. I'm long some Google. I think if it starts to take out 758, you could then have you move towards, the prior highs of 774. I don't know if we need a few days in here. Right now, the moving average is catching up, but overall, this is your resistance. If you're short Google, that's where you should cover. If you're looking for some momentum, that's your area, and that's probably where I'll be adding for motion. Let's hope that happens today. Otherwise, my day will be a little bit frustrating.
So we're going to have a quick commercial break, and then we're going to go into the trenches with some social media stocks.
I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.
Welcome back, everyone. We're going to dive in the trenches right now with the social media stocks. Facebook and LinkedIn are the 2 big names in the sector that we have been focusing on and that have been most heavily in play. Facebook has earnings after the close today, and the stock has recovered very nicely since being cut in half since its IPO. That November 14th igniting bar really set the stage for this rally, and it shrugged off that surprise event that was the graph search unveiling and is now back above pivot highs. Scott, do you expect Amazon? I know expectations are running high into earnings. Do you expect Facebook, to meet expectations and be able to continue higher?
I think expectations are now high, not like last quarter. If you look here at the chart, last quarter you will see no one was expecting anything. It was at the lows. It had a huge gap up, and then it just trickled all the way down to that date that you mentioned when the lockup happened, and that's when it changed for me. It ignited, held higher. This is when we started getting involved in the virtual trading floor, broke above this gap, which was from 2 quarters ago earnings. So you had 2, gaps with earnings. And then you had a continuation all the way to this short-term top. From there, little choppy mess, and then it went back in motion when it went above this 28, and then here was that event. And then since then, it's been chopping around. So today we have earnings. Obviously, you see that Facebook likes to gap. This was when it missed and went to the downside. Here's when it went to the upside. So, there is gapping risk here. So if you have enjoyed this ride and you want to take a little bit of, just say, risk off, but you want to stay involved, do a collar, which means you sell a call to fund a put just in case. So this way you could stay involved. Or if you don't want to come to me, take the pressure or the risk of the actual earnings play. What you do, because there's really a heavy short. There's a heavy short interest, but there's also a lot of premium there. So if you just buy calls, you might be right, it might be up, but you might not make money. So I would think for something like this, you want to do a call spread. If you go back to the, or a put spread if you're a bear. So I'm not giving you either way. I do think that there's vested interest in here, and it could go higher. I'm not sure where I'm going to be. I might just wait till the print and trade it after. But these are the levels. So if you were looking to do some type of call spread, you take a look here again at the chart. Here is your resistance. Resistance isn't that far up. This point is about 33.50, 34. So I think it's trading around 31. So if you wanted to maybe buy the 31s and sell the 34s, you probably, I'm not exactly sure what the net cost is because I don't have it in front of you. You probably are risking, 1 to 2 or whatever you're risking, you can make almost double. or the next resistance really comes in back in IBO day, the IPO day, which is around 36.66. So maybe you want to buy the 31s and maybe sell the 35s, because that will be bigger resistance. Or if you're on the bearish side, you buy the 30 puts and then you sell the 28s, because this will be big support. But either way, I think what I'm going to do is wait till the actual earnings come out, and if I can get it above 32.51, I'll trade it, and if it's bad, I probably will just avoid it.
And LinkedIn has been sort of the grown-up in the sector for a while now. The stock has performed very well since its IPO, holding at upper levels. It's been a little bit choppy over the last few weeks if you're a very short-term trader, but from a swing trader's perspective, there's just been some choppy consolidation near upper levels, and we got that extension a couple days ago. The stock's pulled back a little bit from those all-time highs, but do you expect LinkedIn to be a stock that can have some more upside this year, Scott?
See, LinkedIn has been more proven than Facebook because it's been public longer, and it's actually had a lot of reports that have beat the street. And there's a lot of people that do like their product suite. For me, I think that, which I already did, I have a call spread on, before the run. And I also had some stock on the virtual trading floor for the past, I would say, week or so. And then I sold yesterday as, it was a nice move, but I kept the call spread on. So anyway, this macro chart to me looks like it's been under accumulation, and it's very, very strong. You're talking, this company's almost been public for 2 years. It's got a very thin float. It doesn't have as many shares outstanding as Facebook. Hasn't been talked about as much. I think we got involved in a little bit here. Right above 116 was the buy. Here is your ad. And then, I sold into this extension up here. But what I did is I bought some calls that I think the February 125s. And then once it went up here, I sold the 135. So I think I'm risking, 1.5 to make almost 8. So for me, that's a nice play. Plus, I'll try and trade it after. I do think that this has the ingredients for a $140 to $150 stock. I'm much more, I would say, confident on where this is going, whether it's this quarter or next quarter. I do think at some point this year, we'll be like, oh, remember when we said, LinkedIn could be 140? I just don't know exactly when it happens, and I'm going to try it for this quarter through this quarter's earnings.
All right, we'll go over a couple smaller names quickly in the social sector, not exactly social media, but ZNGA, social gaming stock that it's sort of been left for dead. It perked up and had a big move a couple days ago, but then it pulled back yesterday. Do you think that negated some of that potency of that move?
I'm growing to hate this stock, and I'm going to have to smack around Sperling a little bit because he does well with it by holding it. But anyway, stock just hasn't had commitment. You get one big day, heavy volume, and then it gives it back. The other day, if you look at the chart real quick, I'm not going to get into it, you had a really nice wide range bar. If it was going to show some commitment, it shouldn't have given back this much. It stopped me out again. I guess it could suck me back in if it gets above 285 or starts acting a little bit. All in all, this is a broken stock. It's an avoid. And something's really got to change. Because even if you put the volume in here on the basic studies, you'll see that there was heavy volume attached, to that move down, on this day. So, this type of action next should never have happened. It happened here. It happened here. So this there are problems in this stock, and I would just not be too heavy and just intraday trade it, if anything, maybe. All
right, we'll just go straight into quick hits. We've had some good two-way action in stocks that have been really hot recently. We had a few names that, some stock selective action that have perked up big time. The two specifically are DDD and SSYS, the 3D printing stocks. We'll start with DDD. The stock has been on an incredible run, sort of a parabolic type situation. There was a negative blog post that came out sort of knocking 3D printing. Some people think it's a little bit of a fad and a little bit overdone here with the excitement. We saw a big sell-off in DDD and then a little bit of recovery yesterday. Do you think that big move negated a lot of the strength that we saw from that rally from DDD, or you think this can continue to the upside?
For 2 years, this group has emerged as a leadership group, and those who caught it early, they've probably created some wealth. For me, I feel like I missed a lot of the move, so I'm just kind of trading it back and forth, and I'm actually happy that we've been having that action. Because if you look at the chart here, you will see that it got a little sloppy in here. You had a green day, red day, green day, red day. So some guys were looking to short this when it broke this upper level. So if you had an upper stop and get out of the way, you were feeling pretty good. Where the fact where you had a huge, this bar was so prone to the downside, you would have thought that it would be somewhat controlling, because look what it engulfed. And then yesterday, Sperling made an unbelievable call. It was down a few bucks, and you were able to play it from negative to positive or through the prior day low of 56.16, and it went almost up to 64. So you could have made cute money on the short side with follow through, taken it home short, got follow through, flipped long, and then made yourself a nice trade. So as of this point, I guess right down yesterday's high as a pivot above 63.59. It would be impressive if it could take more back. If the bears have any hopes, of keeping this, to the downside, it can't let that happen. And I probably shouldn't even take out yesterday's high if they want to keep the pressure on. So right now, I just think there's some two-way action. And if you're a believer in this stock, in this group, and you've made all this money, congratulations, look at this move. Just, be a little bit careful and maybe, hedge it somewhat because it's been pretty historical.
The SSYS is the same sector. You want to take a quick peek at that chart, Scott?
Yeah, same type of thing on SSYS, where this one at least gave you, this gave you some more clues actually, where, it gapped up closing the lows, something you typically don't want to see, where you lighten up, and then had some downside follow through. Never regrouped, and then here was the small trend line that broke when it went below the 8 and 21. Yesterday, you did have it hold the 50-day. It gave you a little reversal also from negative to positive. I would say, here's your line in the sand. If the bears want to stay in control of this, it should not get back above this 83-ish. So at this point, just trade it back and forth and give it more time, because it's done this a few times where it's come off pretty hard and then regrouped and continued. This time it might need a little bit more space.
A little note to go with the 3D printing stocks. If you like trading those high momentum, quick moving stocks, take a free trial to the Momentum Mentoring Room with Steve LeVay and Mike Lee. They've been focusing really heavily on those stocks. They're great at trading that two-way type action, making quick cash flow trades. Take a free trial to that room if you want to look at those types of stocks. We'll move on into Netflix, which is another one that, what a move after earnings. No one really expected that type of quarter from Netflix. A stock, in the days after the report, is up over 70%. It saw a little pullback on Monday, but then yesterday it recovered from a gap down, and the stock looks healthy still. What do you expect to see from Netflix?
This one was welcomed because you had two-way action. Also, you had the earnings. It went above the earnings day high, extended, and then you were able to get cute action both ways. And that's been a problem, and the frustration with the market is that it's been slowly, incrementally trending higher with no two-way action. But lately, you're getting a little give. And if you look here at Netflix, you will see, here is the gap up after earnings. You take a closer look. When it traded above the earnings day high, which was 149.17, anyone short got, pretty squeezed, or anyone looking for continuation, there you go. And then what happened is, I know 2 days ago I made some money short. It opened up, put a high in, I shorted it versus the high. When it traded below 172.68, you could have added and closed the lows, gave you actually downside follow through. I didn't take it home short, but some guys I'm sure did. And then it opened up down, showed some relative strength, traded back above the prior low of 160.79, and traded almost up to 169. Sperling was all over that one also. I think, I made a few dollars in the middle, but overall, this is your new little pivot range right here. So this is still acting well. You go to the daily chart on Netflix and you will see that, it does have some resistance right around here, which is probably closer to 200. So the momentum's pent up. You're getting two-way action. It's great to have Netflix back as a trading vehicle for the crew on the floor.
Real quickly, we'll go through three more quick hits. RIMM is another one that sort of is left for dead and is perked up on some speculation over potential takeovers and selling off part of its business. What do you see from RIMM, Scott?
RIMM had a really nice move. We had it on off the charts, I think, at $8, maybe $10. It went as high as $18. It's in the middle of the range, around $15. I think it's just not a compelling trade. You can knick-knack it back and forth, but I'm not touching it.
DELL is one that perked up on some rumors of or some speculation about a possible take-private deal. The stock has continued to hold up well. I see you've been trading on the virtual trading floor, Scott. What do you see from DELL?
You know what? I wasn't involved. And then when that news came out of potentially going private, I kind of believed in it. And I jumped in around 12, had a nice trade. I started getting quiet, so I was flat for the past few days. And then yesterday, there was some news that potentially the deal could be done at 15 versus 14, which made it a bit more exciting. So I did jump back in. I think somewhere around 13.15, 13.20. It went a little bit higher. If you look at the chart, it did hover around here. So I think you could hold it. I do think that there's a high probability that some kind of deal gets done, and it could be close to 15. So at this point, I don't think it's frothy. As long as it stays above now, just say 12.80, I'll try and stay involved here. And if it goes above 13.50, perhaps you see a bit more follow through as anticipation of higher prices could come into play.
And we didn't focus on the entire sector, but the banks continue to lead and hold up well. Wells Fargo has a little bit more of a calculated setup than the other banks. What do you see with Wells Fargo chart, Scott?
Wells Fargo has been a laggard, but if the market continues to could go higher and it wants to broaden out above 35.40, above this tight range. Here's your tight range in Wells Fargo. So I know we're at ex-dividend, so it's trading off a little bit, but 35.46 is that area for it to extend. Goldman Sachs has been best in breed, just extending and extending. It was downgraded twice, so that never happened. It held the 8th day, which has been the vehicle and the roadmap for this one. And then you also, real quickly, have Bank of America, which is trying to hang in there. I guess this hasn't happened yet, where you have this descending little channel. It broke above and it's trying to hold above. So I would say if this gets above 1172, perhaps it acts a little bit better. It's been absorbing the big move that we were focusing on when it broke above this 995 right here. So hopefully it's almost ready to continue. Here's your, your big support, which comes in around now, the 50-day 1094 to 1101.
All right, well, that'll do it for today's morning call. Join us on the virtual trading floor in the mentoring rooms to get a little bit more education on how to trade during earnings season.